I would define it as somewhere around maybe April or May is probably the time period where, we peaked out, somewhere between April and May, maybe between March and May of this year is where prices peaked out. And in some markets, almost immediately the light switch was flicked and prices came down 15 to 20%. A good example was Phoenix. In Phoenix, the 1980s product stuff was selling for, 350,000, 400,000 a door. And, almost overnight it was 300 to 350. And, especially for value add 80s type, C plus to B minus product, it was from what I observed, a very quick shift. And, I would say prices overall in a lot of markets, especially markets that had steep run-ups, probably have seen reductions in the 10 to 15, perhaps as much as 20% range already. And I think they need another 15 to 20% more in order to get to the point where they're going to make sense under today's conditions. Now, that may change. I could say something completely different 6 months from now. This is just where I'm seeing numbers today, and I have to assume, when you're underwriting a real estate investment, there's a lot of different inputs that you have to analyze in order to get an output, and the output is the return that you can expect to achieve, right? And so we're all buyers we're looking for return. That's what we're seeking. And there's a lot of different variables we have to input. Some of them are really easy. Like, what's the rent? Well, the rent is pretty easy. We can look at the comps. We can see what they're getting. It's pretty easy to figure out what the rent is. It's pretty easy to figure out what the expenses are. There's probably enough information now to make some assumptions on expense growth and where that's headed. But there's three inputs that go into this analysis that are, at least for me, extraordinarily difficult to quantify today. And those three inputs are interest rate. Where is interest rate going to be by the time you close a loan and or for the hold period? The second one is rent growth. What is rent growth going to be? And the third one is exit cap rate. In other words, how do we calculate what that sale price is going to be a number of years down the road? And unless we can, with some degree of certainty, pinpoint those three variables, we have to make assumptions that those variables are going to be pretty unfavorable. And when we input those values in an unfavorable way, we come up with an acquisition price that's quite a bit lower than what the acquisition price would have been a year ago, and we had some sense of what those variables were going to look like, even though I think anybody's estimates would now, in retrospect, turn out to have been wrong. But that means that prices have to come down in order to make sense until we can see changes in those inputs where we could say with some degree of confidence that there's going to be X percent of rent growth, or that interest rates are going to be Y or come down to Y, or that cap rates are going to do whatever cap rates may end up doing.
So when you say you could be wrong, is the main trigger there? Is it for some reason in the next 3 to 6 months, 9 months, whatever the heck it is, interest rates come back down another 200, 300 basis points? Would that be the biggest factor, or one of others, and et cetera?
I don't think interest rates is the biggest factor. I think rent growth has a lot to do with it. And part of the reason that you saw astronomical prices being paid was because of rent growth. Even when interest rates were at 3.5%, cap rates were at 4%. It's in some areas under 4%. We were seeing some 3.5 caps trading in the marketplace. And if cap rates are 3.5 and interest rates are 3.5, that tells you right there that interest rates are not the biggest driver of the market. It was rent growth, and people were willing to pay those extraordinarily aggressive prices, because if you're getting 15 to 20% annual rent growth, whatever price you pay today for that stream of income is going to be a bargain for the stream of income you're going to expect to achieve 1 or 2 years down the road after that growth works its way through your rent roll. So now if you erase rent growth and say rent growth is going to be 0, well, yeah, now interest rates become very important. And cap rates have to have some spread against interest rates. You can't pay a lower cap rate than your interest rate with no income growth and expect to achieve any kind of favorable result.